Well, good morning, everyone. I want to welcome you to this ITIF debate on the R&D tax credit. I'm Rob Atkins, president of ITIF, and joined by Marty Sullivan and Steve Pearlstein. I'll introduce Steve in a minute, and he'll sort of kick us off on this debate. But just two notes to start. One is I was really honored that Chairman Camp decided to pick the rollout date coordinate with us to make sure it was after our event. And not this morning, so it's actually really a good timing, obviously, for this debate to happen, because there's certainly a lot of rumors going around on what corporate tax reform will look like, and in particular whether there'll be any changes to the R&D credit. So I've known Marty Sullivan I've known of his work for a long time, and have a great amount of respect for it. So I was very pleased recently when I read his Forbes. What do you write, Fortune or Forbes?
My blog does appear in Forbes, yes.
Forbes, yes. Marty has a very nice blog in Forbes, and I read it, and it was a great blog, one of the best blogs I've read, because it was all saying nice things about our book, Innovation Economics. So, but then, thank you. Then at the end of the blog, or in the middle, the only really thing I didn't like about the book was I thought they were too sort of supportive of tax incentives for R&D investment and the like. So I reached out to Marty, and he was kind enough and a gentleman enough to agree to have a public debate about this, and Steve Pearlstein was kind enough to moderate it. So let me introduce Steve. I really shouldn't require an introduction if you've been in Washington any period of time. He's a business and economic columnist for the Washington Post, and in 2011 joined the faculty at George Mason University as the Robinson Professor of Public and International Affairs. Has a long background as a business journalist in D.C., starting returned to Washington in '88 as a deputy business editor, and then just has written many important pieces on business and economics. He was awarded the Pulitzer Prize in 2008, the Gerald R. Loeb Award in 2007. And then in 2011 won the Gerald R. Loeb Award for Lifetime Achievement in Business and Financial Journalism. So he's a perfect person to moderate this discussion, and I'll turn it over to Steve.
Thank you, Rob. It's a pleasure to be here. I think it was more than 20 years ago that I first talked to Rob. About something, probably the R&D tax credit. It's a little bit like Groundhog Day. We've been here before, and he's really established himself and the foundation as a go-to place for research in terms of innovation and public policy. Marty Sullivan is legendary in the tax world. Anybody who deals with tax policy, or anybody who is a practitioner, has to read Marty's column in Tax Notes. Marty is an economist. He went to Northwestern, got his PhD, worked for the Joint Committee on Tax and at the Treasury's Office of Tax Policy. Is that what it's called?
That's right.
In the 1980s, he spent a short time at the late Arthur Anderson accounting firm, and has been at Tax Notes, almost 20 years?
Almost 20 years.
Almost 20 years. Rob got his PhD in city planning at the University of North Carolina. Did some work in Rhode Island, and was at the Office of Technology Assessment on Congress for a while. Does that exist anymore?
It does exist, but it has no money, so in theory it exists. It's never been eliminated.
I see.
Defunded.
Yeah. Well, that's something an economist could like, an organization that exists in theory.
It does good theoretical studies.
Anyway, we're going to have a little debate today on the R&D credit, and it says here that Marty is going to start for 12 minutes. Rob will have 12 minutes, and then they'll each have 10 minutes for rebuttal, and then they'll have to answer some questions from me and then from you. So why don't we start?
Thank you, Steve. Good morning, everybody. Thanks for braving this wonderful weather. it's really an honor. It sounds like hyperbole, but it really is an honor and a pleasure to be on a panel with these two gentlemen because, unlike most everybody else in this town, they don't carry a heavy partisan agenda. They don't worry about offending people when they think they are doing the right thing. So if you're looking for partisan labels or even industry labels on either of these folks, you're not going to find them. They're really searching for the right answer. And so that's kind of, I think that's pretty rare in this town, and that's why I mentioned it shouldn't be rare, but it is. Rob, can you remind me what the title of your book was in 2000? Not the last one, the one in 2006. I love this title.
It was called had the Past and Future of America's Economy, Long Waves of Innovation that Power Cycles of Growth.
Not that one.
Oh, supply side.
The supply side.
That's a good
title too.
That's another one. Supply side economics, why conservative economics fails, liberal economics falters, and innovation economics is the answer.
There you go. So he's made enemies with everybody with that title, and I like that. That got me very interested.
So Jared Bernstein read that book before I published it, and he said, Rob, after you write this book, you're not going to have a friend. Only friend you'll have is your dog.
Well, if it matters at all, I just admire that type of work, and so I think it's really important. And so I think this is billed as a debate. I don't think we're going to be screaming no chair. Steve said we can't throw chairs, but it's really going to be more of a discussion about how we go about achieving what we think is the best answer. And I'd be given the short end of the stick because I have the very unpopular position of discussing why we might want to repeal the research credit. And every president since Ronald Reagan, George H.W. Bush, Bill Clinton, George W. Bush, and the current president who wants to, every president favors making the credit permanent and expanding it. And almost every economist favors it. Liberals favor it, conservatives favor it. So I got nobody. I have no allies here. But the only thing that makes me commit this suicide mission is that I've been doing this, despite my youthful appearance, I've been doing this for 32 years. When I was at Northwestern, my mentor, Robert Eisner, got a grant from the National Science Foundation to study this newfangled thing called the research credit. This was 1982. The credit became law in 1981. So I spent 2 years in a room without windows studying the research credit. And then I went to the Treasury Department. I wanted to do other things, but given my background, they assigned me to the research credit. So I did the credit there for 2 years. Then I went to the Joint Committee on Taxation where I wanted to do other things, but given my experience, I had to do the research credit for 4 years there. And then I went to Arthur Andersen and I wanted to learn about international and travel the world, but that kept pushing me into the research credit. So I can't get away from this. And I've always given it the benefit of the doubt because the economics of the credit are really stellar. But I just feel it a necessity to inform people who might not be as familiar with the inner workings of this credit. It doesn't work so well. What looks good outwardly may not be so good when you take a closer look. And I feel that responsibility. And if I could have a slide.
There's a clicker.
Oh, clicker.
Just try the press forward button.
Which way do I aim it?
Right, there we go. Yeah.
Okay, why do we love the research credit? Unlike most other tax incentives, which are just there to help things that somebody likes without any good economic justification, there really is a solid economic justification for the research credit. Now, I could have done a supply and demand curve diagram and elasticities, but I thought I'd just make it as simple as I could for myself. And the guiding principle, which makes the research credit really stand apart from all the other junk in the tax code, is that there's an economic justification. And the justification is, if I go off mic here, is private business invests in research and they get a return from it. What kind of returns do they get? They get more innovative products, which increases their profits, or they get they figure out how to do something better, which lowers their costs. So they have all the incentive in the world to invest in that. But something else comes out of research, which is what economists call externalities, or what more often you hear them called, for people who are trying to be cool and not sound like economists, they call them spillovers. But what it is it's, I think the best way to think about it is It's knowledge. Knowledge flows, can flow very freely. And with these tremendous spillover benefits, private business left to its own devices will not invest enough in research. And the free market doesn't work. And so we have to correct the free market with a subsidy. And so that the knowledge will spill over to the rest of the economy and we'll have an optimal level of research. So we're not going to debate about this. This is very basic economics. And it's something very worthwhile looking for to figure out a way to get this to work. Okay. Having said all that, now for the negativity. And I think it's something that most people don't recognize because they don't work in the tax world. And when you look under the hood and you see what's going on, it's not that pretty of a picture. It doesn't work out this neatly. Okay, it's been 33 years, and what do we have? We have a credit that's still temporary. Congress cannot make it permanent. In fact, we've had 15 extensions. We're waiting for the 16th. It is right now, technically, it's not part of the law. And maybe someday, Mr. Camp and Mr. Wyden and the President will extend it again, as they've done 15 times before. So even though everybody agrees it should be permanent, including myself, they just don't do it. Okay. It's been 33 years, and we still have a very convoluted credit structure that nobody can agree on. Let's go back to 1981. The folks at the Treasury Department, very smart people, said, wow, we see these spillover benefits, we want them in the economy, and we want this credit to really have a large incentive effect. So we're going to make it incremental, which means we're not going to give the credit for if you spend $100 on R&D, we're not going to take 10% of that and give it to you. That's called a flat credit. We're going to only give you credit for increases going from, let's say, 100 to 120 or 130. And so I won't go through the history of this, but over the course of these 33 years, we've had 3 or 4 different ways of calculating that incremental credit. And there's no one perfect way of doing it. The main point that I'd like to make today about it is, when you have all these different types of bases, you put the incentive effect of the credit is not uniform. Some, I won't go through, the way we measure the incentive effect is something called the marginal effective rate of credit. And I've done the calculations a million times, as many others have. Some firms get 14%, some firms get 10%, some firms get 5%, some get 3%, and very importantly, some firms get 0%. And so this credit is not uniformly distributed. That's the first thing to notice. But then it's been 33 years, and what's the other problem? What else have we not resolved about the credit? And this is the main point I'd like to make. We really cannot figure out what the heck research is. What is the stuff that you invest in that makes this happen? And if there was a store where they sold research in a box for $100 and you could do this, I'd have no problem with it. But I think when push comes to shove, you can't really define research, and this is at the heart of all the problems. Okay. Let me just mention a few other problems, get a few other facts down there, we can converse more. Startup firms without tax liability. Because this is a tax credit, if you don't have tax liability, it doesn't really help you. Startup firms don't get it, so therefore you would think about making the credit refundable. The reason why that's particularly important is, again, I have no love affair with small businesses. I think they have more than enough tax advantages. But in this case, they do have a justification, which is, I think most of the studies say that small firm research, dollar for dollar, is more productive than large firm research. So the credit is not well targeted in that respect. But that can be remedied by making the credit refundable. There's another, the other thing to mention is that, and it's very relevant for today, because there's breaking news. When we just mentioned background, there's at least 4 other ways to incentivize research. Under Section 174 of the Code, put into law in 1954, under normal income tax principles, you should capitalize R&D and write off. So if you spend $100 on R&D, perhaps you should write off $20 a year over 5 years. And in 1954, they said, just expense the whole thing, because that's simplification and it's incentive. So we already have that in law, and that's about an order of magnitude about as equal to the current credit. So we already have A, Section 174 expensing, and then B, we have Section 41, the credit. And so we already have something in the tax law which incentivizes credit. The other thing, that most people forget about, but it's an enormous factor, is because of our international tax laws, a lot of R&D done in the United States, there's no tax liability, because you're able to take those profits and put them offshore into tax havens. So you invent a new drug, a lot of those profits, those patents can be relocated to Bermuda, and you don't pay any tax on them. So we already have features in the law that incentivize the research credit. And then there are non-tax features of the law, of government policy. We have direct government expenditures in R&D. I think it's over $150 billion a year that the government puts into the funds of research. And then we have patent policy. Since I think it's in the Constitution, we grant patents so that inventors have an incentive to innovate. So we have other tools for making this work. The breaking news that Politico reported last night, and of course it's all rumor, nothing's confirmed yet, and 5 minutes from now I may be proved wrong, that Mr. Camp, as part of his tax reform bill, which will be introduced formally around sometime this afternoon, will repeal Section 174, and which is the expensing provision, and keep the credit. So it's so he's taking away the provision that's been in law since 1954 and leaving the credit in, which I think is a very strange way of going about things. I probably have no time left. Is that right? Okay. Very quickly, can we? Oh, I have a slide. Oh. Definition of R&D. I'll just give you guys a flavor of what's going on. 1981, Congress passes a law, says we have to have a credit for R&D. Well, what's R&D? They didn't really define it well, so in 1986, like I said, let's tighten it up a little bit. So what is R&D? I mean, you sit in a room someday and you have nothing to do, try to figure it out, and you'll quickly become very confused. But what the tax expert said is you should have to discover information that's technological in nature, it should contribute to development of a new and improved process, and it should constitute elements of a process of experimentation. Okay, pretty good. I think this is too narrow and too broad at the same time. For example, why does it have to be experimentation? I mean, you have theoretical work, you have theoretical physics that produces knowledge. Albert Einstein's work wouldn't qualify for the research credit because he didn't do any experiments. So I want to point out, I'm not just in favor of narrowing the credit. In many ways, the credit should be expanded because the definition is not very precise. Just give you one episode real quick, which was in the tax world, it was a huge deal. Clinton administration, 1998, they said, just going back, when we say discover information, what do we mean by that? Who the hell knows what that means, right? Just sit down and think, what does that mean? You can't really define it. But they tried to define it. And they said, it is discovering information exceeds and expands or refines the common knowledge of skilled professionals. In shorthand, what people have said about this, it has to be a revolutionary discovery. You have to really discover something new that people didn't know about before. And the business community rightly was up in arms about this for two reasons. One is it clearly violated congressional intent. Congress didn't want a rule this tight. And second, they said, how the hell is an IRS agent and a tax director of a major corporation going to know when the technological advances, they have to have PhDs in physics. And so the Bush administration comes in, they immediately repeal the regulations, and now they say, You don't have to have a revolutionary discovery. You kind of have an evolutionary discovery. And so if it's something that you didn't know, that's uncertainty to the taxpayer, you're resolving some uncertainty, not a discovery for the whole world, but a discovery for yourself, then that qualifies for the credit. Let me just convey to you that, as well as I can, that if you look at the GAO report in 2009, if you look at the Joint Committee pamphlet in 2012, you can read pages and pages about the complexity and the inadministrability of this credit. I think the best way to describe it is a chaotic quagmire that will never be ultimately resolved. What does this leave you with? You have a credit structure which creates all different types of effective tax rates, 12, 14, 5, 3, depending on where you are. You have, and 0. You have an imprecise definition of the credit. Some of it's making spillover benefits, some of it's not. Some work that genuinely deserves it's not getting it, so we're all over the place. And then finally, because of the uncertainty, not just from Congress because they don't extend it, but because of all the controversy between the IRS and taxpayers, when you start to do the research, you don't even know if you're going to qualify. You're only going to find out 3 or 4 or 5 years later after you go through an audit. So given the uncertainty, the imprecision of the definition, the scattershot incentives provided by the structure, I think at some point you got to say, this ain't working because it's just not operational. That doesn't mean you shouldn't have incentives for R&D, but this is not the right way to go about it. And I'll just throw it about that. Thank you.
Rob?
Well, great. Thank you, Marty. You actually did the first sort of 14-20% of my talk, so I don't even have to do it, so I appreciate that. I do want to say, though, you said you're a lone voice, and I actually don't think you're a lone voice. I think there are an increasing number of people who are in the camp of what we call radical base broadeners, rate reducers, who are so fixated on getting the rate down that they will throw everything overboard to get rid of the ballast and get the rate down. And so there have been a lot, and we've reviewed that. There are more people now who question this. So I was going to go through the long history of economic thought on this, which I'm not going to do, but Ken Arrow, Richard Nelson, let's just say, I 100% agree with Marty. There is a clear economic, it's just not in doubt that firms underinvest in research from a socially, economically optimal rate. One study, Corton, found that the social rate of return from corporate research is 3 times higher than the private rate of return. Jones and Williams from Berkeley found that the optimal level of corporate R&D is actually 2 to 4 times higher than what they currently perform. So companies underinvest in this because of spillovers, and the response has been that we need some sort of incentive. Now, the question is that incentive valuable or effective? Now, Marty said, well, it's not because we have these issues with permanency, we have these issues with definition, and you might get challenged. Okay, so I'll get to those in a minute because many of those are fixable. The real question, though, is even with the current structure of the credit, what level of R&D does it incent firms to do? And in that, there really is, again, no real serious dispute in that in the economics literature. 2007 CBO report found, quote, most studies have clustered around the finding that $1 claimed under the research tax credit leads firms to spend an additional $1 on R&D. OTA study before that found these are what we call elasticity, so elasticity of 1. I actually think that elasticity of 1 is under number. Most economic studies actually find something higher. Bloom, Griffith, and Van Reenen, $1.10. Hines found it $1.20 to $1.60 of added R&D from $1 of tax expenditure. Hall and Van Reenen found in the long run an elasticity of 2. Recent study by Nipurami Rao, I think from Princeton, found for manufacturers it's an elasticity of 2.26. And Klassen, Pittman, and Reed found an elasticity of 2.96. Now, I'm sure you're not going to remember all of those numbers, but the point is most of the studies find that even with the structure, it leads firms to do more R&D than they would otherwise do. And there's a lot of other studies out there that show that R&D improves productivity, adds to more patents, and leads to economic growth. So, I think there's one other compelling reason, though, for this that we haven't really touched on, which wasn't a reason when we created the credit in 81. And that is R&D is much more globalized and mobile as an activity today than it was back in even the 90s. There's a study done by Berkeley economists looking at California high-tech firms and found that R&D was the activity most likely to be offshored. 60% of firms reported they had offshored R&D. Only 22% had offshored back-office work. Why did they do it? Cost was the single most important driver for moving R&D offshore. And that's why we see corporate R&D by U.S. companies, according to the BEA, has grown 2.7 times faster overseas than all R&D, corporate, domestic, and foreign, in the U.S. over the last decade. So what we're seeing is that companies, U.S. companies, are expanding their R&D offshore much more quickly. Why are they doing that? Because the other countries have very, very generous R&D tax credits. When we put in place our credit all the way up through the early Clinton years, we were the #1 R&D credit in the world in terms of tax generosity. Those numbers Marty alluded to of 6 or 4 or 14 or whatever that is. Average those out, we were the #1 country. We just had Jacek Wardra, who had been long-time OECD consultants, to do their OECD R&D credit rankings. They changed their methodology recently, which he and I didn't like, so Jacek did his methodology again, used it for us. And what Jacek found is that we now rank 27th in the OECD among, in terms of tax, in the world, in tax credit generosity. There are countries out there that have R&D credits 2, 3, 4, 5 times more generous than we do. So I think that's an important reason now that people miss that R&D is mobile. Not having a good R&D incentive structure will mean that we will just lose R&D. Now, there are people out there who say, potato chips, computer chips, what's the difference? We don't really need R&D, and I won't go down that path because I think that's just fundamentally wrong. R&D is a core part of our innovation economy, which is a core part of high-wage jobs. What are the concerns here? I think there's several different concerns. One of the main concerns is really about discrimination and distortion, and that's some of what Marty was talking about. Some firms might get this, and some firms might get this, and big firms get more than small firms, and Home Depot gets nothing, but Intel might get more. Yes. But public policy is not designed to treat every single firm or individual alike. The goal of public policy is to maximize net economic welfare. And there's a wonderful quote by an economist at the Canadian Treasury Department that we've cited, and he has a great quote, and he says, not all distortions are anti-growth. There are actually distortions that are pro-growth. So I think, I know Marty's not saying this, but there are people in the debate who say, we don't really like this because it's distortionary. Look, that's not the right measure. The right measure is it distortionary that leads to increased welfare or reduced welfare? Marty did talk a little bit about the size issue, which I think is valid, although I have to say that according to the GAO, small firms account for 5.2% of R&D but get 7% of the credit. But still, I agree, we could do more there. There's a bill that Senator Coons, and I think it's with Senator Rubio, has to make the credit refundable for smaller firms, which we support. So I think there are changes. And I think maybe Marty and I might agree on, in an overall sense, is credit's not perfect, and we should be thinking about some changes. Another concern you have, and although Marty didn't bring this up, is that the credit is expensive, and we should use the savings for the credit to bring the rate down. This is what I think a very, very common view now. You can, according to joint tax, I believe, if you get rid of the credit, just eliminate the credit and expensing, you can bring the rate down by 1 percentage point, so from 35 to 34. That to me is not a lot, and it doesn't really get you very much. The other problem with doing that, and conversely, another benefit of the credit, I'd support the credit, Marty, even if it spurred no R&D. And the reason I would do that, which by the way it does, is because it tends to go to traded firms. firms in traded sectors, I should say. And there's, I think, a very good sort of advocacy or policy research now, particularly out of IFS, Institute for Fiscal Studies in the UK, that argues that tax policy should be more favorable to traded firms and less favorable to non-traded firms. In other words, Home Depot is not going to move their stores to India. Pepco is not going to move their utilities to China. But traded firms will and do on the margin. So the fact that the R&D credit, most of it's going to manufacturers and information firms who are mobile, I think that's important. All right, so then let me just sort of start to wrap up by talking about the real, I think, crux of Marty's concern is about the credit's complicated structure. And I agree that won't go into a lot of detail. There's basically there are two credits. There's what's called the regular credit set up in '81, and there's what's called the alternative simplified credit set up in 2006. Many of the complication factors are with the regular credit because of the very, very difficult time of figuring out what your base is and how. I'm fine with getting rid of that, but I think the ASC is a much simpler credit. The ASC was established precisely because of concerns over the regular credit. And what the ASC does, it says, okay, we're going to measure how much R&D you're spending every year. We're going to average it over your last 3 years. And then this year, we're going to give you a credit of 14% on everything you spend that's above 50% of your base. So if you spend $1 million on average over the last 3 years, and you spend $1 million the next year, you get a 14% credit on $500,000. That is a much simpler type of credit. Now, the reason it hasn't, I think about half people take the regular, half take ASC. If ASC were bumped up to 20%, which is what we would support and have supported, and there was a Hatch, there was actually a Hatch Baucus bill at one time that did that. That I think would move many, many more people over to the ASC. Marty talks about the problems with the fact that the credit is temporary. Yeah, that is a problem, but all studies show that the temporariness of it reduces effectiveness. It doesn't eliminate its effectiveness. It's still effective. It just could be more effective. And again, I mean, that's kind of, if the problem is temporariness, we should make it permanent. So, but I take your point there, Marty. Even though everybody says let's make it permanent, we don't. But at least from a logical perspective, the answer would be let's make it permanent. So let me go to Marty's main point, which was it's hard to define research. I don't think that's as true. First of all, I don't think it's as true as what Marty said. And secondly, these sort of changes over time, partly that's about politics, but partly it's about trying to say, okay, we try one definition, there's some problems with it, we'll modify the definition. I don't see that as a problem. We're trying to make it better as we go along. Reality is a lot of R&D is not complicated in terms of definitional terms. A corporate freestanding laboratory that employs mostly scientists and engineers, that's pretty straightforward. There are other things that are a little bit on the margin, and I think firms over the years, through dealing with their major accounting firms who specialize in this, they generally have not a perfect sense, but a reasonably good sense, looking at past decisions from Treasury, looking at the rules, what will qualify and what won't. Now, that's not to say that we couldn't make the credit definition, the definition of R&D easier and more simple, which I think we could. I know that Center for American Progress, Laura Tyson had a study which argued you should apply the same definition for expensing. So there are some things that we could do there. The last point, Marty said, well, we already do a lot for helping spur R&D. But I don't think that's enough. Corporate R&D as a share of GDP is stagnant in the US. We're nowhere near the top in the world. There are other countries like Japan that invest much, much more than we do, who have a more generous credit, by the way, I would add. It talks about patent policy. So all of those studies that I alluded to, that talk about the spillovers being essentially on the order of 100%. So you capture only 50% of the benefits of your R&D and they spill over. All of those studies are in the context of a robust patent regime. So patenting helps. If we didn't have patenting, we'd probably spill over 75%. So patenting is not enough. Direct grants. There's two problems with sort of relying on direct grants. Number one, at least I think number one, they have a higher administrative cost. There's a study of the R&D credit in Canada that found that the administrative costs of direct grants were about twice as high, 1% administrative cost for the R&D credit in Canada, 2% for administrative grants. So you have a little bit higher costs there. But I think the two other big problems with direct grants, relying on them, number one is, look, with the politics we have today and the budget problems, we're going to see cuts, more likely cuts in federal R&D. Now, if you're an economist, you're like, well, grants and tax expenditures are the same. If you're a politician, they're not. Particularly if you're a conservative Republican politician, they're not. You're more likely to support tax incentives than you are grants. And then finally, from an economics perspective, Greg Tassi, who was the chief economist at NIST, has done really the best work on this. And Greg's analysis, who, by the way, supports the R&D credit, his analysis is, for a robust technology policy for any country, you have to have grants and credits. Credits are sort of the backdrop of, sort of, if you will, the background environment, so it gets everybody to do a little more. Grants are where you want something more specific, where we might say, look, we really, really want to do advanced metals research because we need stronger metal for the Army, so you do grant programs there. You're not going to get that with the R&D credit. R&D credit is much more about the broad brush. So let me just close by saying, I think that what we need to be doing is expanding the credit. I would certainly go up to 20%. But I do agree with Marty that there are some design issues. I would think one of the things we should do in the ASC is go up to 75% of base as opposed to 50 and then add to the credit. So there's certainly some design things, but I wouldn't throw the baby out with the bathwater. So, thank you.
I had to laugh a little bit about the base going from 50 to 75. It's very arcane stuff, but in 1990, when I was on staff, we had a 75% base, which is something I personally advocated for, and the industry lobby came in and pushed it out. It's so obscure, I'm surprised anybody even remembered it, so it was interesting. Let me just say from the tax point of view, I've worked on incentives and credits for my entire career, and always the issue, it's a very interesting issue, is what is the stuff that you're trying to incentivize? And let me give you some examples about things that work well and things that don't work well. Back in the olden days, before 1986, we had an investment tax credit. It was for equipment, or as the lawyers call it, personal property. And it was pretty easy to define what that was. There was a lot of debate around the edges. If you have a building with an elevator in it, is the elevator equipment or is it real estate? And you kind of get into those issues, but you basically knew what it was. And the other thing you have is very important. In the real world, you have tremendous pressure from the tax practitioners to expand that definition, and they don't give a hoot about the policy, and I don't blame them. They're just trying to get more tax benefits for their clients. And they are relentless, because there's tremendous amount of money in this. And so if there is any degree of flexibility, they will go to Congress, they will go to the IRS, and they will fight with their agents to figure out how to do it. And sometimes they can get pretty messy. Let me give you another example. This has nothing to do whether you're in favor or against a carbon tax, but just measuring carbon is very easy to do. You burn a ton of coal, you know down to a few milligrams how much carbon comes out of that. So if you were designing a penalty for carbon or an incentive, whatever you prefer, it's very easy to identify the amount and design policies around that. Some things that don't work are in 2004, we got something new in the code, section 199, manufacturing deduction. And we won't go into why we should or should not incentivize manufacturing, but what the heck is manufacturing? And you kind of, you start out, everybody sort of has a plain vanilla view, smokestacks and so forth. But when you put pressure on that definition, it all changes, because the lobbyists and the practitioners are all going to start identifying stuff that you never thought of before as manufacturing to be that. And we got into a tremendous morass, and we're still fighting that today, about what is the dividing line between manufacturing. And I just saw at a conference Bill Thomas, who was chairman of the Ways and Means Committee the other day, and he said something to the effect, he goes, well, I greatly expanded the manufacturing sector, and of course he was making a joke about not really, but as the definition, everything in the world became manufacturing. So when you have squishy stuff, the tax practitioners will squish it. That is an absolute definite. Many years ago, a friend of mine, he was working at the Department of Labor, a very brilliant young economist, and he said to me, what we need is a tax incentive for training. Training is very important. I agree that training is very important. But how do you define training? Where's the dividing line? When your boss shows you how to work the machine, is that training? Does it have to be a formal program? How do you measure the dollar? So the reason why you can't have a tax incentive for training is not because it's not a good incentive or a good idea. It's that you can't define it. It just can't. It's just operationally impossible. And what I think, when I started working on this 30 years ago, we said to ourselves, well, they're going to have a hard time defining this, but let's give them the benefit of the doubt. Got a lot of smart people. Well, it's been 30 years, and I think we have to disagree a little bit on this. It has not worked out, and it's never going to work out. They've tried, and they've tried, and they've tried, and they've tried, and there is no bright line between what is research and what is not. And it's not just a little bit messy, it's very messy. We all talk about wanting tax simplification. I think the research credit is probably one of the most complicated provisions of the law. And it might be worth it if the spillover benefits are large enough. But I would, if you look at this more closely, some of the stuff that they're saying is research is not stuff that you would normally think about. And the flip side is, I think sometimes the IRS becomes overzealous because they feel so helpless, and they're too aggressive. So we're all over the place. And so what I'm saying is the administrative issues are not small. And when you're designing an incentive, you have to look as, can you administer it? And they have not been able to. And I guess the difference between my view now and 15 years ago is you say, well, maybe they can make it permanent. And maybe they can figure out a new structure. And maybe they can figure out a better definition. But it's been 33 years, and there's no end in sight. And I would just say, with the modern economy, Rob talked about, in the olden days, we had a building, which was the research facility, and guys with white coats with test tubes did stuff. It's going to be harder and harder and harder to define what research is, because we do things so much differently these days, and that's great. And I would rather see us rolling up our sleeves and getting to work on the research, and not spending all of our time with accountants trying to figure out how to make this work. And it's becoming I think it's just very unsightly. And we should try to, we could do things like incentivize more young people to become engineers. I think there's so many other ways we could look at to incentivize research. And I'll leave it at that.
Thanks. So, by the way, you mentioned the ITC back in '86 eliminating it, and that it was a relatively simple thing compared to things, but we eliminated it, which I think was a mistake. We now invest about 30% less as our corporate sector invests about 30% less in in equipment and machinery and software as a share of GDP than we did pre-'86. I think that's partly why. But anyway, you mentioned some of these. I think if sort of perfect simplicity is the touchstone, then yes, we have to eliminate all tax incentives, because there is no such thing as perfect definitions of anything, even carbon. But we don't, because we think that the role of public policy is to change behavior, to move resources to one part of our economy from another, and therefore things aren't going to be perfect. There's not going to be a bright line. But that doesn't mean that if you're pretty close, that's not a good enough second best. Marty talks about the Section 199, the manufacturing code. Well, we have to remember on that, the reason we did that is because the EU, European Commission, took us to WTO on our incentives for exports, because they all have border adjustable VAT. So we could solve that problem with a border adjustable VAT. But in any case, though, Marty, I think it's one of those sort of popular things. I know you're not saying this, but there are economists and policy people who go, oh, Section 199, geez, it's actually funding hamburger restaurants. Austin Goolsbee has said this. Okay, well, let's actually look at the data. 0.4% of the tax deductions in 199 go to the entire hospitality and restaurant industry, hotels, restaurants, you name it, 0.4%. The lion's share of 199 goes to manufacturing and software, which is exactly what it's supposed to do. Again, not perfect. I agree with you. There's a lot of aggressive tax consultants out there going to get their little piece, but it's still not bad. The other part of this is 34 or so other nations do this. They struggle with the same challenges we struggle with. They are all moving in the direction of expanding their credits, with the exception of Canada. Nobody is cutting back. They're all moving forward. So either they're sort of completely screwed up and dominated by corporate lobbyists, or we're missing it. So can't be both. And then I guess the last point I'll make is there's this sort of mantra out there, this holy grail of simplification. Simplification is not a not an end. Simplification is a means. There are lots and lots of things in the world that are complicated. If we really want simplification, we should eliminate the government. That would simplify things dramatically. We don't. So I just, yeah, you want to simplify things when you can, but if what you're doing costs money, administering the credit costs money, no question about it. Costs money by the government, costs money by firms, but it is probably cheaper than grants. And the point of that, again, is it's not that we should say that there is no bright line. There is no bright line. But again, I don't think that if you look at the sort of the transaction cost involved in figuring out where you draw that line on an ongoing basis and on a case-by-case basis, to me, that's more than worth it. That's more than worth it because we're getting more R&D than we would otherwise. That R&D, the tax expenditures are going to firms that are in intense global competition. So if we cut the credit, just hypothetically, we eliminate it, get the rate down to 34. Now everybody now pays 34. The end result of that will be that the effective tax rate of innovation companies will have gone up, and the effective tax rate of non-innovation based companies will have gone down. I don't think that's a very good result because I think A, will have less innovation, and B, non-innovation companies, more of them are domestic serving than innovation-based companies. And so I think we'll lose our global competitiveness at the margin by doing that. So maybe Marty and I should get together and a task force of people to figure out how to make the credit better. I would love to do that, but I would caution against throwing it overboard.
Okay. So I'm going to admit it ahead of time that I think more like Marty than like Rob, so I have more questions for Rob.
That's one.
Than Marty. Rob, imagine a firm. Imagine a firm that has $1 million in sales, and it's not a hugely high-tech firm, but they do some. Sort of an average firm that's not a service firm. What percentage of its sales do you think it might have for R&D?
If it's an average firm, I would think it would probably have somewhere around, say, 3%.
Okay. Should we say 5% just because it make the number
Fine, make it easy to count. 5%, yeah.
Okay. So let's imagine that this is $1 million firm, and it spends $50,000 a year on R&D. And let's imagine that it has a net profit or a taxable profit, not a net profit, but a taxable profit of $5,000. Okay? Here's the sort of political economy question that I would pose to you. You made the assertion that if you got rid of all the R&D and you got rid of the expensing, which both, and Marty actually didn't come out in favor of the expensing, but let's assume we got rid of both. It would only reduce the marginal rate 1 percentage point. Okay, that's a true. Let's say that's true. But the truth is that most people are looking at this as part of an overall tax reform. Getting rid of R&D, not because it's particularly bad, on the hierarchy of tax preferences, it's probably one of the better ones. But if you're trying to get simplification and you're trying to get rate reduction, it's part of that package. Now, let's say that you can do that in a way that gets the rate down from 35% to 25%. All right. Well, if I've just taken 10 percentage points through tax reform off of the tax bill of this firm, this is a 10 percentage points on my $5,000 profit is $500. I'm sorry, my $50,000 profit is $5,000. Okay, guess what? That's probably more or equal to the benefit from the credit on the firm that you just described. Okay, so I would sort of argue from a political economy point of view, that is a realistic political standpoint, that it's not a 1 percentage point matter, it's a 10 percentage point matter or an 8 percentage point matter. And in that case, the firm actually might do just as well from rate reduction as from the R&D credit if getting rid of the R&D credit were part of this package. And so that's perhaps the better question before us, is which way you would do it. And you would have to agree, I think, would you not, that that's a less distortive thing. I mean, it doesn't discourage R&D, but it doesn't encourage it either. It's part of a general thing. So I wonder if you could sort of respond to that.
So first of all, I'm dubious that the apples to apples comparison in this debate is 35 to 25 on a revenue neutral basis. Other people know this was a joint tax or somebody.
Yeah, you can do 27. I think people agree that 27.
Even debatable about that. But I think one of the problems with this debate is people look at this, they we'll get rid of a few of these, and they look at 25, and they're not comparing apples to apples. If they're comparing apples to apples, it might be 29. Then you get into a different dynamic. Is 29 worth it to get rid of all these? But let's just look at this one. Okay, so leaving aside politics for a second, that firm that's doing the R&D would be much better off with a 26% rate and the credit. So
you're saying you can get the lower rate but preserve this one thing.
I know that is a sort of this notion of actually trying to do policy in Washington is sort of strange, but yes, I actually believe that would be good policy. We can have a political discussion in a second, but here's the thing. By definition, I mean, this is sort of, it has to be true. A firm that is taking more of the credit than a firm that is taking less of the credit, their effective rates will lower by a differential amount. So let's just say a semiconductor firm who's taking a lot of the credit now because they're spending an enormous amount of money on scientists to figure out nanotechnology for the next generation of Moore's Law, and you get rid of the credit, their effective tax rate is going to go up. Walmart's effective tax rate will go down because they do no R&D. So I don't see it as this comparison, Marty. I mean, Steve.
I think it's from a political standpoint fantasy to say that the ideal policy from this point of view, which is encouraging innovation, is to have tax reform except my tax break, because everyone will say that, and as a political reality, the only way you get rid of any of them is to get rid of all of them, or almost all of them. That would include all the big ones, and this is one of the bigger ones.
Well, I think to defend Rob,
okay,
is that the R&D does have a special place. Because of the externalities that it provides. So it should be on a little bit more of a pedestal. It has a halo around its head that makes it more defensible. But on the political economy, if we go back to 1986, the original credit rate was 25%, and it was reduced to 20%, and there was some tightening of the definition. And I think the view at the time was, to reinforce your political views, that everybody's got to pitch in. No, that's not good. That's not economic policy. It was just that we want a little bit from everybody, And of course, that's one of the essential political dynamics of tax reform, that for people who don't recognize that R&D has a special place, and if you repealed everything and just left the R&D credit, they go, well, who the hell are these guys and why are they getting special attention? But they do this, again, I still don't favor it, but from there is a policy, a very, very strong policy justification for leaving R&D out of the tax reform revenue raising pile.
I have two other points I wanted to make. One is, you mentioned about other countries doing this and are not doing it. Well, if you were a cynical person, you might say, hey, that's fun, and you were an economist, you might say,
Isn't that the same?
no. You might say, hey, this is great. We're going to get all the spillover from their tax incenting research. We get the advantage in the global economy of all the spillover, and we don't have to spend the money on the tax credit. So why not be a free rider? You make it seem like, oh, this is a race, and we're behind them. And the race you talk about, some of us in the tax reform world refer to as the race to the bottom. But we're in this race. But actually, if you really want to think about it, the best strategy for any player is to be the free rider and let the others do it, because especially in a globalized world with, by the way, international firms, you get almost all the benefit of that.
So it's a really good point, because certainly that's in the Australian debate over their credit. That's a point that the opponents are bringing up, and actually it has more validity in a little country where you're not going to be doing as much share of global R&D. But the evidence is pretty clear, and I'm happy to share that with you, Steve. We've done several reports on this that have cited the evidence, when you do R&D in one country, how much spills over to another country versus how much do you keep? And big countries keep a lot of it. In spite of this, so yes, we do, there's no question, if Japan does more R&D, we do benefit from that. I actually don't see this as a race to the bottom. I see this R&D tax race as a race to the top. It's a race to get the global economy much, much more innovative. I mean, I think one of the things people miss on this, I blame it on neoclassical economists, they treat innovation as sort of manna from heaven, which is what Solow called it, and it's sort of some natural law. Look, we should be doing twice as much R&D in the world, and we should be solving problems twice as fast, and if we all did that collectively, we'd all be a lot better off. So, hey, I don't want the U.S. to be a free rider, but the second point is it's not about free ridership here. There are a lot of clear benefits between, I mean, there's a lot of actually studies, particularly by Gary Cardano and Willie Shih from Harvard Business School, that review the literature on the linkage between R&D and early stage production. So if you're not doing R&D, you're not going to be doing the early stage complex production, the high value added, high wage. You're not going to, shoes, even making, assembling iPhones. That's not early stage, and it's commodity based. But Boeing makes its airplanes, a lot of its airplanes. They make a lot of it here because they're doing R&D here. Intel puts its chips factories here. TI puts their chip factories here because they want it close by their R&D. There's a lot of, even in the internet world. So I just don't think that that's true for a country, particularly one as big as ours.
However, when you look at a multinational doing R&D, if it's doing R&D in the United, well, actually there's a lot of literature about how within a multinational they actually don't share information because it's those guys over there, and those walls are breaking. In a modern corporation, obviously it is incumbent upon the management to make sure the information is spread worldwide because you're a worldwide company, and vice versa when they're doing it in the foreign jurisdiction. So I think one of the we talk about globalization and it's changing everything. One of it is it's going to be increasingly, whatever happened in the past, it's going to be increasingly more difficult to keep that spill. We want it to spill over, but not too far. And that's a very tricky balancing act. And we have to recognize, and this goes for all types of R&D, not just that, this is not a criticism of the R&D credit, but we can't keep it all inside the United States, and vice versa. We can rip it off from other other countries. When I was at I can talk about Arthur Andersen because they're gone now. But when I was at Arthur Andersen, I thought I was coming up with all these brilliant ideas, and I tell the management we should do this and we should do that. And what they'd say is, pipe down, Sonny. What they'd also say is, we'll let somebody else do it first, and if it works, then we'll do it. And that's what they always were, a follower. They invested nothing and took no risk because of their market power. No, I'm just saying.
And how they do it?
Yeah, how did they do it? Good point. But the spillovers, I mean, R&D is a very different, it's intangible property, and it's very squishy, and you have to take that into account, that we may not be able to capture all of the benefits of our own research.
Steve, quick question for you. Do you, I think, as I've from reading your work over the years, I think you support NSF funding, National Science Foundation funding.
Yes, I do for basic research. Sure. Because basic research, the spillovers are even greater.
Right. Okay. So I'm just going to point out the illogic of saying that we shouldn't do the R&D because we should free ride on their research, but public research we shouldn't free ride. We should actually do the opposite by letting everybody else free ride.
No, those are you might say the same thing about basic research too. If you and your point is we're a big country, so we can't really be the free riders. So that's a valid point.
Yeah. Okay.
The last thing I would say, Rob, is you mentioned a number of things. Actually, you sort of led with your chin a little bit because you're defending the R&D tax credit, but then you mentioned that actually you also support the manufacturing credit and you also support the investment tax credit. So someone might listen to this and say, this guy, I mean, he will do whatever, anything that he thinks will benefit the sector of the economy that he favors. He will use grants, he'll use tax credit, he'll just do everything. And you really do believe that the government should pick winners and losers, should decide which are the important parts of the economy, and should basically favor them. It's a very intrusive role for government in the economy, and you favor it all. Aren't you? I guess what I would say is, haven't we learned anything over the last 100 years about the role of government in doing that? I mean, what you say would have been really great 15, 20 years ago when we thought the Japanese model was the way to go. But you're still defending the Japanese model or the Korean model, when I think much of the world has come around to, markets are pretty good, and especially in technology, things are changing. Why do we want to be telling people, yeah, if you invest in this, if you do this, we'll send you checks? They create high-wage jobs. You want to send them a check for that. If they give good benefits to the workers, you want to send them a check for that. I mean, pretty soon, we'll be in Korea territory.
By the way, President Obama at 3 o'clock today is going to give a speech about manufacturing, and I think
manufacturing is good and research is good.
It's a version of what you're talking about. We're going to pick out a particular sector and favor it.
So a couple things there. By the way, I'm a big supporter of the ceiling fan tax deduction. I really think that's something we really need more ceiling fans. Look, there are really stupid and bad tax policies, and there are good ones. And again, this sort of Manichaean view we've gotten into in Washington, all or nothing. I'm supportive of tax policies where there is strong economic evidence of spillovers and market failures. And that's completely the case with R&D. And by the way, very interesting, we did a fairly comprehensive review of the literature on capital investment, and not in buildings. There's no spillovers in buildings, but there are actually pretty big spillovers in the literature for machinery. Well, I would say, okay, that's good. Now, this point, so I was...
Spillovers for machinery?
Yes, believe it or not. They're actually the size...
Tell me about that.
Larry Summers.
It goes Larry Summers and
But what's the spill? What don't you capture?
So there's seven different things in the literature, but I won't go through all of them. But one is just simply, when you buy a machine, you're not just buying a machine, you're restructuring your production system. And so the spillovers are the learning that the workers have and the engineers of how to do the new machines. They go to a new company, and there's that.
Oh, okay.
There's 7 different ones in the literature. I'll send you the paper, and it's on our website if you're interested in looking at it. The paper is called something like Corporate Tax Reform for the Global Innovation Economy. But secondly, I was on Fox Business or one of those TV shows recently, and I was accused by my opponent of the R&D credit as a big statist industrial policy type. It's like when I was accused by one person of that. They asked me whether I was a Stalinist or a Trotskyite. I said it's Trotskyite, of course. And I was shocked by that because we, ITIF does not advocate picking individual firms. We don't even advocate picking individual narrow technologies. We do sort of say that there are certain technologies that are going to be important to the country, like robotics, like semiconductors, like biotechnology. But even that, we don't have to have that argument, Steve, because that's not what the R&D credit is. It's about a function of the economy, not a sector. And so it's the farthest thing from industrial policy in the world to me. It's sort of the anti-industrial policy, because it's not government saying, I like you three, but you four I don't like. It's saying, look, anybody in the economy who wants to contribute to knowledge is going to be good. The last point is, you say, why am I favoring these sectors? I don't favor these sectors. I don't favor these firms. I don't care about firms. What I care about is, can the U.S. economy have a high rate of productivity, innovation, and global competitiveness, because that's how we're going to get GDP growth and, you know, high wages. And these are good tools to do that. So I don't care about firms. I don't care about sectors. What I do care about is getting the kinds of policies that are going to stimulate the kinds of people. So you're right. And the other thing I will say, I actually do think there are much bigger market failures than we take for granted. I was on a panel with Clay Christensen from Harvard last year. For Clay Christensen, you know, the business school guy, and Clay made this point. Oh, that was very interesting. U.S. firms increasingly invest in incremental innovation and not disruptive innovation. And the research shows that they've cut their basic research, and their scholarly research, cut their basic research funding, increased development. Why? Not rational for them, it's not rational for the economy, and they do it because of stock market pressures.
Short-termism, yeah.
Short-termism. Are we just going to throw up our hands and say that's the market? We're gonna back off of short-termism?
I just wrote a paper on short-termism for Brookings, but I'd rather deal with that, which is an endemic and widespread problem, than do it this way. But I need to go ahead, Mark.
I just want to say, I think that we've all said, or I'll add, that basic research is more productive than incremental. Or let's say revolutionary versus evolutionary. And I think the credit is not really incentivizing that type of core research, the breakthrough research. It's spread out over a lot of stuff that is not really going to change the world or even come close. And it's just very inefficient. Now, if we could target it somehow find a bright line to get there, that would be...
well, that's a good comment, that then I was going to get back to you on that. Okay, Marty, you say that, you know, the practitioners and the companies would, apparently with the connivance of the tax agency, have gradually increased the definition of R&D. So it includes all this stuff that is what you would consider, and we would consider, probably marginal. So why let the perfect be the enemy of the good? Mm-hmm. Why don't we say, you know, if they're wearing white coats and they have a PhD and it's in the lab, okay, we get it. And if you're not, it's not. And if you think that's unfair, you know, well, we missed some things. It's imperfect. Let's not let the perfect be the enemy of the good. There is a lot of that stuff that does go on that you could clearly define and delineate. Why would you be then opposed to it if we could do that?
No, I think what we've laid out here today is a framework. There are external benefits, perhaps very large, from research. Those are what we want, and I want to get back to Section 174 and the Camp Bill, if I can. But let me get back to. But then we have another problem, which very few people look at, because it's a very unattractive issue to get your head into, which is how this thing operates. For most economists and policymakers, it's a black box. But for the tax practitioner community, it is a morass, a quagmire.
It's a gold mine.
It's a gold mine. There is something called an absolute moneymaker in the tax business, which is called the R&D study, R&D credit study. And the consultants come in and they go through your firm and they find all your R&D. They find the maximum amount of R&D that they can find. Then they file an amended return for the prior 3 years, and they get 30% of whatever the tax savings is. This is objectionable because if the firm besides the complexity.
It obviously wasn't an incentive, was it?
Well, that's my point. There should be no retroactive research credits, because if I didn't know about it when I did it, obviously it didn't incentivize me unless you're some sort of time traveler. Now, for lawyers, it seems, how could you not allow me to get my fair share? And that's understandable. But we're not talking about measuring income. We're talking about trying to provide an economic incentive. And so there's a huge disconnect. And so it's a very unattractive part of tax policy. And, you know, on something, it's like transfer pricing. We're never going to get the right answer. We're never going to get it. And but with transfer pricing, we have to do it because you have to allocate income between jurisdictions. This is something we volunteered to do for ourselves. And let me just get back to Section 170.
Well, I need you to answer my question.
I'm sorry, I did. Okay.
Why not? You don't think you can just say, you know, if it's in a lab, if it's in a lab, they have a PhD and they're wearing a white coat, and I'm being facetious.
Yeah, no.
You know, you qualify, and if you don't, you don't.
Well, the problem is you can't draw the line. For example, under the regulations, if I clean the test tubes, my salary qualifies. But if I sweep the floor in the lab, it doesn't. And you go, well, who cares? Well, if I manage the R&D, you know, I come down and I tell the scientists in the white coats.
Look, Marty, look, what if we say, if you're going to do this research, okay, for the tax credit purposes, it has to be in a separate building with separate people, not 80% of whom has an advanced degree, okay? And every year we're going to come and inspect, all right? And everything in there is deducted, including the janitor, okay? Because it's all part of the cost of doing the R&D. So we'll just say you need to set up a separate tax haven within your company, and we'll come and look at it, and maybe even increase the R&D credit for that.
Well, I would favor a more contracted definition, but again, the world is changing. And we don't, laboratory research, I mean, there's a lot of things that go on. I mean, it's once you start getting out into the real world with all the different ways that all the different companies operate, you know, you have the flat organizational structures. You don't have labs. You have innovation occurring on the shop floor. You have innovation occurring in the boardrooms. You have computer simulation.
We'll miss that.
That's right.
But why let the perfect be the enemy of the good?
No, I agree. See, that's why I'm in favor of something like, I would say, just those with advanced degrees who work on research, broadly defined, just their salary should be included. Something like that. Look at some harder definition that you would be
Now you wanted to get to something about the Section 170 something.
Section 174, and it's again, I mentioned it before, and it's relevant because if my reports are correct, Camp is advocating its repeal. I think that is a great incentive. For just the opposite reasons that I think the R&D credit is a horrible incentive.
Okay.
Because in 1954, what they did is they said, we can't, you spend money on R&D, and you spend money on something that's close to R&D, we don't know where that dividing line is. Congress said that.
Right.
And we're tired of trying to figure it, because under prior law, if R&D would have to be capitalized and therefore have much less tax advantages. And Congress said, we can't distinguish between that. So tell you what, we'll let you expense everything. We'll treat everything like an ordinary business expense. That was an incentive that simplified the law. Great. It achieves much of the same purpose of the R&D credit. That is a good way to incentivize R&D. But with the R&D credit, we did exactly the opposite. What we did was we said we want to incentivize R&D, but we're going to make the law incredibly more complicated, and I would say borderline unadministrable. And so I think that's a big difference. And now that Camp is proposing, let's get on my soapbox, keeping the credit, which is the complicated, very difficult thing to administer, and getting rid of the provision of the law that's simple to administer, I think it's just entirely backwards. But we'll see as the days unfold.
Just a quick, the problem with expensing is that you have a zero limit. You can never make it more generous.
That's the problem.
It is what it is, and so
if we could double it, we could, but you can't.
You can sort of do negative expensing, but we can't. And so that is one of the problems. Is even if we just that expensing, we're still going to be way, way behind what's optimal.
Rob, would you agree that if we had to have one, which I know you won't consider, but imagine we're a different planet, a different century, if we had to have one, which one would be preferable?
Well, with the caveat being that they both have the exact same value of tax expenditure, and there was no way to increase the credit, then I would go with expensing.
Right.
But that's the caveat.
That may be the choice. That's the choice that Mr. Camp and the tax reformers are putting on the table. I'm not saying you should accept it, but
I would go for expensing and a more generous credit.
One more quick question. I just want to ask you, Rob talked about elasticities ranging from 1 to 2.5, though 2.5 is only for manufacturing. Are you okay with those?
well, as somebody who's measured a lot, I've done a lot of those elasticities. I think that they are very hard to measure. I think that there's a bias in the studies, not that anybody, I think there's a bias towards, many of these studies are funded by people who want a large elasticity.
Right. Is there an assumption bias in them, though? Is there some assumption that underlies them? That
No, and let me just say it this way. If I'm a lobbying group and I'm funding a study, and Steve Pearlstein does the study, and he gets a low elasticity, well, Steve would never create a big elasticity just for the money. But if you did put out a report like that, it would never see the light of day. So I think there is a bias in the numbers. I think they're unreliable, not because the people are unreliable, but because these are very, very hard things to measure. So, but I will just say, dollar for dollar. For every dollar you spend on research, you get $1 of additional R&D, or maybe 2, or maybe 3. The dollar value of the research credit in 2010 was $8.5 billion. So if you get 1, you get $8.5 billion more in research. And if you get 2, which is at the high end, might even be higher. I don't know. Might be 3 times. You get $24 billion. So we're talking about whether we're going to get $8 or $16 billion more in research. The amount of research done in the United States in 2010 was over $400 billion. So we're talking about stuff on...
Not by corporate.
Not by corporate was 250, government was 150, very generally speaking. So we're not changing the world with this credit, even with the upper end estimates. And it's just something to keep in mind, is that if the credit went away and even the upper tier estimates were taken into account, there would be a reduction in R&D, but it would not be the end of the world. I'm not saying it's something we should do, but it's saying it is not as though $250 billion worth of R&D is going to leave the country.
To clarify, I may be naive, but I don't think Brownell and Hall studies are funded by industry. There certainly are some that are, but I think there are many academic studies that are not funded by industry, that are just pure scholarly research. But this is the point, Marty. Look, that argument to me is then if it's true that we get for 8 we get 24. Let's just slice the baby in the middle, 16. Great, and we underinvest in the U.S. by an order of magnitude of by 100%. Then really what we need on the corporate side is $500 billion a year. So why don't we increase the R&D credit to 60%, and then we'll get closer to that. One could make that argument.
No, and let me say, I think you can argue that the credit, that the amount of incentive, not necessarily the credit, could be much larger. I'm not disagreeing with that. Maybe if we had my theoretical world, if we had a credit that was operationally could work well without all the complications that I'm bringing up, maybe the credit should be 60%. I'm not disagreeing with that. What I am disagreeing with is the morass of complexity when you look under the hood of the credit, what you find. But I'm open to that being a possibility for sure. I'm not anti-corporate.
Okay, let's take some questions from the audience. Yes, sir.
Yeah, Jim Wazzy from GAO. I just want to make a comment on the elasticity literature.
Jim would know.
In that, I agree with Marty that these elasticities are difficult to estimate. There's a lot of uncertainty. But a real problem in the literature is that people equate the elasticity with the bang per buck for the credit.
So it's not the but. It's not but for.
Right. It's a percentage change in research spending for a percentage change in the price of research, but you don't know. None of these studies. We did a review. None of the studies out there looked at how the structure of the credit affects how much revenue it takes to reduce the price by a percentage. And so, you know, the more that you have windfalls in the credit, that's going to lower the bang per buck relative to the elasticity. So I think, you know, there's very little, if anything, known about the bang per buck in the credit.
You want to say anything about that, Rob?
Well, there are bang for buck studies, which there's several there are a number of bang for buck studies in other countries that I've seen, and I know there's at least one bang for the buck study here which said it was positive. So,
but none of them
sure, positive, but
yeah,
dollar for dollar bang for buck.
None of those were based on the actual structure of the credit. You know, you all make, you know, you can make an assumption, but, you know, unless you're looking at the actual data, you don't know.
How would you even do such a study? How do you establish the counterfactual on such a study?
That's why it's difficult to do. And obviously, you know, the responsiveness is going to vary from firm to firm, so you have to know who's getting the credit, and you have to know how much windfall you're giving up to get the incentive to that. So that's why I think, you know, there's so much uncertainty about it.
Has there been any natural experiment with some island has passed, you know, some island has passed from one jurisdiction to another jurisdiction, and one had it and the other didn't? And
but even if you did, that would be relevant for that particular design of the credit.
Well, I know, but if there were if there was an island with a lot of different firms on it, you might be able to see that.
So there is a cross-national study, which I can get you the site for, which I don't have maybe I have the footnote for, by Reinthaler and Wolf, that said the bang for buck is 1 for 1. Now that again averaged over countries.
Marty?
Yeah, we spent years working on this bang for the buck issue. Okay, everybody goes, why the heck do you have that dumb regular credit based on 1984, 88, if folks know what I'm talking about? Well, the reason is, and I have to say, the reason is we're trying to increase the bang for the buck. The industry came in and said, with the old credit, we weren't getting a large marginal incentive, and we'll never be able to withstand the criticism of the economists if we don't increase the bang for the buck. So we're going to change the credit to have a larger incentive effect. That was 20-something years ago, and everybody looks at it and they go, "What? Where the hell did that come from? Why the heck they do that?" You know, with so much legislation. And so now everybody, including the president and I think your group, is advocating moving to what we call a moving base, which is much more user-friendly. Well, why are we doing it? Well, the reason that is going to significantly reduce
The bang for the buck
bang for
from
the
whatever
buck.
it is today.
And so, and this just goes back, and this is not to argue this all over again, but here we are again, 30 years later, and we're back to square one. We're actually back to the same, pretty much the same base that was proposed by Ronald Reagan in 1981. And we keep cycling, you know, and 30 years from now, we'll probably go through the cycle again, because everybody's trying to find a better way of doing it. And I don't want to be, all I'll say is I've spent 30 years, I can't figure it out. And I don't think anybody really has.
Yeah, but to be fair, so I did this exercise one time where I had a spreadsheet I was modeling multiple bases and multiple things.
Sorry to hear that.
No, the answer is you're right. There's no, what I concluded, there's no perfect answer. But again, I don't think we should let the enemy, the enemy good. I mean, one thing we have proposed is go to a 5-year base, which ASC, which gives you a little more. And so, and go up to 75%, and that gives you a little more. I mean, I think we know the direction we have to go in to get.
But there's always the trade-off when you make it broader and more. I mean, industry always wants it broader because it's spread more evenly and they get more. Every time you do that, you reduce the bang for the buck significantly. And so you're always playing, and of course, industry doesn't care two hoots about bang for the buck, except for the criticism of economists that might ultimately upset the whole apple cart.
Any questions? Yes, sir.
Bill Kelly, American Society for Engineering Education. What are the tax implications of a company funding its R&D at a university laboratory?
Marty?
If I believe it is, that would be contract research, and so if I spent $1 million getting Duke University, that's where my son goes, at Duke University to do something, I would be able to get 65% of that as credit. And the reason why it's 65
credit.
Yeah, 65%. I mean, 65% of that 1 million would be creditable, and then you apply the 20% rate or the 14% rate, depending on which credit you use. So
Is that a more tax efficient way of doing it than doing it in-house?
No, I don't think
It's not that it's
agnostic on that point.
It's not more tax efficient. It's that companies increasingly are sort of outsourcing their basic research to universities and building these research partnerships, which are actually very positive, I think, to the innovation system. But again, we're such an outlier on that. There are at least, we did a report on that, there are at least 10 countries that incentivize that. We disincentivize it by giving you only 65%. There are countries that give much. Canada, for example, if you're a company in Canada and you do, say, research at Waterloo University, you're going to get a 60% credit on every dollar you invest at that university.
But of course, there is a difference in that in Canada, the government owns the universities.
Well, and the reason for the 65% was when you look at regular corporate R&D, in-house R&D, a lot of that doesn't qualify, and they were just trying to make that a level. For example, if you've ever been within a university, if you get a research grant, you spend
40% off the top goes to the president.
Yeah, 40% on the top goes.
But the logic of why other countries do this more is because, and I think this is pretty clearly definitive, the spillovers from doing university research are much bigger than spillovers from doing in your own lab, because these guys publish it. And so that's, you want to incent it even more, I would argue, not less.
Mm-hmm.
Okay.
Yes, sir. Just to that point, part of the credit we haven't talked about today is there is a basic research part. And if you give money to the university for basic research, then 100% of that qualifies for the basic research credit.
It's very small.
But the universities, firms by and large ignore that. It's to the minuscule level.
Because it cannot have any commercial possibility ever. That's the definition of that.
And we know that in advance.
Well, that's what the definition of that
It's very small.
provision component is. Yeah.
Thanks. I want to get back to the international free riding aspect a little bit on the tax credit and comparative countries picking winners and losers. I'm from Samsung, and you mentioned Korea, Stephen, as an example. But conflating the Japanese and Korean models in terms of economic growth and diversification over the last 20 years is kind of hard to do, with Korea going up and broadening, whereas Japan has continued to stagnate. So that's an interesting observation. But on the other aspect,
just a little bit behind Japan in its development cycle, so you wouldn't expect them to be at the same point.
Right. But there has been, and our company has been a winner, but there are the free riding aspects of U.S. consumers being able to buy lower priced TVs and smartphones as a result. But there, on the other hand, if the U.S. didn't have the substantial R&D tax credit that we've had, although I wasn't inside the minds of our decision makers at the time, I'm not sure that we would have established the R&D in the U.S. As a positive externality and the close by manufacturing to go with that. So to Rob, I guess I'm asking, is that kind of one of the examples of when you compare R&D tax credits around the world, a positive externality that you actually can measure in terms of numbers of high-tech jobs that people hire here in the U.S., including from internationally based companies?
No, absolutely. There's a study.
It's got a study for it.
Yeah, I do. We do. That's what we do, Martin. There's a study that found that affiliates of U.S. multinational corporations increased their R&D investments roughly 4 times more in countries offering R&D tax incentives than in countries that did not offer those incentives. So they have an effect increasingly on location, and that's partly why Samsung, I think what I'm hearing you say, that if we didn't have that, you might have put that plant in Ontario or British Columbia.
We're at the end of our time, so I'm going to have one more question.
Thank you. Mark LaRouche from the National Science Foundation. My office every year performs a survey of business R&D, and I will say that we don't lose a lot of sleep overnight coming up with a definition. That's the first time actually I've seen the terms of the laws and scratched my head, yeah, that's pretty vague, but we've got something that's a lot better. And actually, if you look internationally at the statistical offices, it all comes from the OECD Frascati manual, and in redoing the business R&D survey that we did a couple of years ago, we looked at FASB rules and everything else, and this stuff is all pretty clear. I think the one thing that worries me, and particularly in light of Steve's comment indicating a preference for basic R and basic research as opposed to the other parts of the channel. The thing that's really breaking down is actually the so-called character of work distinctions. It's getting harder and harder to see how basic differs from applied, that differs from development. And what's kind of emerging in terms, and there have been efforts to try to come up with a totally different classification, 5 or different things, in a sense preserve a linear model. It really doesn't work, because really what's going on is you've got these different things that we can see from a theory point of view. Yeah, there's a kind of thing that's basic and applied in development, but what's happening is arrows are going back and forth and around and in circles and all kinds of things. And so one begins to worry when one tries to apply this policy to facilitate something like basic, which does have clear spillover effects, to other things that we think has less. And I think the argument becomes that all of this stuff has spillover effects, and therefore you've got this condition that Rob pointed out, that you've got market failure and you've got spillover effects you need to recognize in some kind of way. And then you've got the politics of the tax policy and what the accountants are doing and everything else on top of that. But it's a complicated circumstance.
They do great work at NSF. There's no doubt about it.
Well, we try.
Maybe you should take over the credit from Treasury.
Yes, please.
Right.
Thank you all for coming. Thank you all.
Great, thank you.